Hi there, my name is David Teague. I tutor accounting, and this video is for students. So if you are taking an accounting class right now, you are in the right place. I'm going to treat this just like I'm tutoring you, and if you want to tutor with me personally, then please send me an email. My email is in the description, and we can set it up, and I will save you a lot of time, so feel free to reach out and we can do this one-on-one. But this video specifically is going to be about the accounting cycle. So this is mostly a broad context kind of thing where I just want you to be able to explain to yourself and others what the accounting cycle is, because it helps you make sense of a lot of the things you're going to be doing in your class. So let's get started. Okay, so I've put myself in the corner of the screen so now you can see more of what I'm doing. So I'm going to number 1, 2, 3, 4, 5, 6, 7, 8, 9. So there are 9 parts of the accounting cycle, and they make a lot of sense when we go through them. So let's start with the first thing, which is a transaction. And this is probably what your chapter starts out with. And it probably says something like analysis, or we have to analyze a transaction. So we look at something like selling something or performing a service or issuing common stock, and it's a transaction, and we talk about what makes a transaction and how do we talk about how that transaction impacts the company. That's step one. But then we actually have to record it. So we go and we make a journal entry of that transaction, and that's in the journal. So that's why it's called a journal entry, because it's in a journal, traditionally speaking. And that's where people get confused, because now we're talking about debits and credits, left and right, and it just starts to get messy. After we do our journal entries, we then can post to the T account or to the T accounts. Now, T accounts aren't like an actual technical term. Really, it's the ledger, but we call it the T account for our for just learning about it, and it's an easy shorthand way of recording and keeping track of what happens in a particular account, like cash. You'll look at the cash T account and you'll see all the additions and subtractions to that particular account. So it's a summary of all the accounts, the ledger. But the journal is a summary of all the transactions. So first, in step 1, we say, here's a transaction. Step 2, we journalize it. Step 3, we throw it into the T accounts. And then we can make a trial balance, which summarizes, it's like a table, and it just summarizes all of the T accounts. It lists them and puts their balances, shows the debit and credit, and then all the debits equal all the credits, and we're fine. It balances, it's all good. That's step 1. Steps 1 through 4 are probably one chapter for you. If it's anything like the students that I tutor, it's one chapter that takes you through all that right there. And then the next chapter, so your whole first test is going to be going through this, I'm assuming. The next step is the adjustments. I'm just going to write adjust. So we do, you know what, I'll do adjusting journal entries. The adjusting journal entries are tweaking things and basically hitting refresh on all of the expenses and revenues from the period and making sure that they're properly recognized before the end is recorded and everything is put together. So they're a bit more tricky than your traditional journal entries because there's no transaction motivating them. It's more of the period is coming to an end, and so we have to go in and make adjustments. So that gets confusing, but I'm going to do a video on all of these individually, especially journal entries, regular and adjusting. Now, number 6 is the adjusted trial balance. So it's just like the regular trial balance in number 4, but number 4 is the unadjusted. Then we make adjustments, then we have an adjusted trial balance. It's that simple. So now we can make financial statements. We can actually make the income statement and the retained earnings statement and then the balance sheet and the cash flow statement. We can make all of those things now because we have all the accounts totaled up for the period. Once we do that, we can make our closing entries, which means we're going to zero out our revenues, expenses, and dividends and move on with our lives. We'll move into the next period and start fresh. We'll start recording things from zero. Just the temporary accounts, revenues, expenses, and dividends. And then at the very end, we can do a post-closing trial balance again. So that probably won't be covered in a chapter. I haven't seen it covered so far, but it's really easy. It's just a trial balance, but now all the revenues, expenses, and dividends are zero. And it's ready for the new period. So the whole point is we've closed everything and now we're ready to move on. We've closed all the temporary accounts. So your first couple 3 chapters are going to take you through, what is accounting, who cares about it, and how are some standards made, where do they come from. Then you get into all this, and then you probably have your first test. So I hope this was helpful for understanding the accounting cycle in the broad context of what you're probably doing in class right now, because I'm fairly certain that you're somewhere on this list, you're somewhere in this journey. And so please look at the other videos where I go into these specifically, and also email me so we can meet one-on-one and I can answer your questions about your class, your homework, your tests, and I can really help you quickly and save a lot of time for you. So thank you for being here. Please subscribe to this channel as well, and I will see you in the next video. Thanks again.